Finally. Alright, so what I have here is a PowerPoint with the basic topics that we're going to cover over the next couple hours. As I move along the concepts that are in the PowerPoint, I will switch back and forth to the Excel examples so that we can work on those as we move through the materials. We're going to cover three basic things: the basic financial math and Excel functions. I understand that you covered some of this with Ross over the last sessions. I'm just going to do a refresh, show you how the functions in Excel work, how to format them. Then we're going to go over the financial accounting principles and how to apply them in Excel. And then finally I'm going to give you some basic or the basic steps as to how to build financial projections using Excel, and we're going to use an actual financial model that is very detailed, and I'll show you step by step how you build those financial projections using Excel. So those are the three things we're going to cover today. With these materials, then we should be able to have the foundations to then build a financial model from scratch, and so that's what we're going to do next session. And then after that, we should be ready to work on the project. So let's get started with the basic financial math and Excel functions. This is very basic, so I'm just building the foundations from the very beginning. Okay, so if this is too basic, just please bear with me. We're gonna move rather quickly on the first parts and then focus more time on the financial modeling part. So the first thing we need to cover, the basics that we will always be looking when doing financial models and analyzing companies. Please come in. We'll be looking at margins, ratios, and growth. These are the three basics that will always be used again and again in one way or another. Margins, we're going to look at gross margins, operating margins, pre-tax margins, net margins. So it's a very simple concept. It's just costs and expenses or profits expressed as a percentage of revenues. Or for instance, when we were analyzing working capital or some other balance sheet items, inventories as a percentage of total assets. Then we have ratios, slightly different than margins. In ratios, what we're looking at relationships. It could be between financials, or it could be financials and operating ratios, like for instance revenues per square meter, or EBITDA per square meter, or leverage ratios like net debt to EBITDA, EBITDA being earnings before tax, depreciation, and amortization. Growth, so you want to calculate how fast a financial figure is growing. Equity, assets, revenues, net income. You want to see the time series, the progression over time, how it grows. So margins, that's the basic formula for a gross margin as an example. What I'm going to do now is move to the financial model and functions Excel file, where we have some very quick examples. So if you go to that file, to the margins tab, there what I'm doing here is just a basic calculation, just assuming just figures. Revenues 103, costs 80. The unit margin is the difference between sales and costs, so the margin would be the unit or the contribution margin divided by sales or revenues. And if you want to use the formula, it's simply sales minus costs divided by sales. So that's your margin. Okay. And then you can play around with the formula, and you can start with a margin and a sales figure and calculate your cost. Simply you multiply one by the other and subtract from the initial figure, or you can start with unit cost unit margin or contribution margin and cost, and then you can calculate the gross margin expressed as a percentage. And finally, you can also start with costs and contribution margins to calculate sales. So it will be simply the addition of one by the other, and with the same margin formula you can calculate the gross margin. So very simple. That's in terms of margins. Ratios, as I said, this is a relationship between two independent metrics. This can be financial metrics, or a mix of financial and operating metrics, or just operating metrics. Debt to equity, coverage ratio, operating income to interest expense, payout ratio, which is total dividends divided by total net income for the period, just one divided by the other. Going back to the Excel file, some ratio examples. If a company has 100 in debt, 50 in equity, the debt to equity ratio would be 2 times, one divided by the other. If we're looking at coverage ratios, if the operating income is 200 and interest expense is 45, then the operating income to interest expense coverage ratio is 4.4 times. And you can also do it the other way around. You can start with a payout ratio, for instance. So a dividend payout ratio of 75. So you distribute 3/4 of net income for the period. If the net income is 345, then you apply that payout ratio to the net income, and you can calculate what the dividend payment will be for the period. So that's ratios. Growth rates. Growth rates, we first go over simple growth rates, so one period over the other. So the growth rate will be equal to the final value divided by the starting value minus 1. That's the formula. There's no time effect. You're just simply calculating the absolute change from one point in time to another. And a growth example here would be for the example I have here is 3 companies, a mining company, a tech company, and an old technology company. The starting metric, the final metric, and the growth rate. This could be revenues, net income, book value of equity, have a starting value, a final value, and the growth rate will be final value divided by the starting value minus 1. It's very simple. And as is the case with ratios and with margins, you can play around with the formula and calculate growth based on final and starting point, or you can have a growth rate and a starting point and calculate the final. So these would be the 3 formulas: growth as a function of starting and ending values, the ending value as a function of growth and the starting value, and the starting value as a function of the final value and growth. That's just moving the algebra around. Very simple.
So I have a question.
Yes.
So the future value, is that something that we would think up on our own, or how would we derive that future value?
Well, the beauty of financial math is that it is very intuitive. So just the basic algebra, if you look at the first equation here,
Right.
growth equals final value divided by starting value minus 1. Just with a basic algebra, you can figure that out, that if you have a growth rate and a starting value, you just move the figures around and with very simple algebra calculate that.
Okay, but what if we only have like one value? We only have the starting value.
If you only have the starting value, then, and we'll get that when we look at projections, one of the key aspects of making financial projections has to do with your assumptions. And your assumptions would always be based on analysis. So you would do analysis on the historicals of a company. For instance, you have a set of 5 or 10 years of financials. So from analyzing those historical financials, you can see where revenues are, how revenues have grown, how margins have moved through time. So when you're trying to make an assessment about the future, you don't have the future value. You don't know how much the company is going to grow, but by analyzing the historicals and applying strategic analysis, how the company is positioned in a certain industry, supply and demand dynamics, you can then derive your basic assumptions. You can say, okay, so these are the demographics for a certain market. This company has a competitive advantage because it has certain technology. It's the number one dominant player. So the demand will grow at a rate of, let's say, 2 times GDP. And that is, let's say, 6% nominal growth year over year. So you apply that to your projections. But that would be based on analysis and take into consideration many different variables. Okay. All right. So that's the growth, and then the next step is the compounding effect. What we just saw was the absolute growth from one period to another. But if you apply that growth over a number of periods, and you have a time series, you have 5 years growing at 5% per year, for instance, your ending figure will be much larger than just the 5% because it's compounding year over year. So what you're doing is simply applying period over period the same formula, growth equals final divided by starting minus 1, but introducing the effect of time, how that compounds year over year. So the way you do that is the compounded annual growth rate now will be a function of the ending or final value divided by the starting value, but elevated at the power of 1 divided by the number of periods. So the inverse of the periods that you're compounding the same rate over time, minus 1. So, for instance, if your starting point is 100 and your final point is 259, and you want to calculate this through, let's say, 10 years, you can calculate the compound annual growth rate implied in those numbers. Or, the other way around, you can have a starting point, you can have a final point, a growth rate, and derive the starting point based on those numbers. Going back to Excel, you go to the CAGRs tab. What I have here is the 10 years starting from 0. So your starting point is 100. Your growth rate is 10, so you grow at a constant rate of 10% per year. And what you're doing is you're applying that growth rate to the base every year. So every year you calculate a new base that has grown 10% compared to the previous year. So if you go years 1, 2, 3, 4 up to 10 and apply the same year over year, then that's how you get to the 259 figure. And as I said, if you compare the two figures, the 259 compared with 100, it's clearly not 10% but 159% because of the compounding effect over time. And as I said, you can also move around the algebra and calculate starting or final point or the growth rate depending on which variable you have. Now, the next thing, Ross told me also, you've touched on some of the Excel functions that are most commonly used in financial analysis. NPV, or net present value, internal rate of return, the number of periods, the payment, the implied rate over a series of cash flows. Then some statistical functions like minimum, maximum, average. Then there's a useful, I find it very useful function, is error, just to clean out data. I'll show you how it works. If, and, or, which are also very useful when you're analyzing and you're trying to figure out analysis out of sets of variables, or have a compounded formula that you want to look at. So I'll show you just some very quick examples of how those functions work. Net present value, this is to analyze the net value that a set of cash flows will create or will result in. So conceptually, what we're looking at is if you have a project that requires a certain number of investments, let's say at the beginning of the life of the project, and you have an expected set of cash flows over a number of years, and you have a cost of capital, the cost of opportunity to making that investment, you can determine what is the net present value in present terms, so in current terms. So what you do is, for instance, in this case, what I'm assuming is a cost of capital of 5%. Let's assume you're financing this project with a loan that will cost you 5%. So let's assume that your cost of opportunity is 5%. You have other projects that at least give you a 5% return. And you need to invest 1,000 at the beginning of the period, and you expect to get cash flows of 300 for the next 5 years. And then, let's say if this is a piece of machinery that has a useful life of 5 years, so that's the end of the project. What you do is, very simply with Excel, NPV is a preset formula, and it will be a function of first the discount rate, in this case 5%, or cell P3, and you're going to discount the cash flows included in the cell range P4 to G4. So the initial investment and then the subsequent positive cash flows over the next 5 years. And the Excel does it for you. So the net present value in this example is 284. Of course, the net present value is a function of your cost of capital. You have a higher cost of capital, the net present value will be lower. So if we double the cost of capital to 10, the net present value goes down. Yes.
Does Excel automatically take value 1 at time 0?
Yes. Yes. So the preset formula has that built in. Okay.
Because we have another formula in our book, and our professor told us in last class
Yes.
that we have to add those thousands, to the formula, like to calculate MPV from the T1. I mean, use the 300, positive 300 for those 5 periods.
Yes.
And then add the initial investment.
That is also correct. You can also do that. But Excel is also already accounting for that. And the reason it's accounting for that is this is the first column is time 0. So there's no time effect for that minus 1,000. You don't need to discount that a year or 1 period because it's the starting point. So what you can do is...
Excel is not discounting because the result is different.
Yeah,
So-
I got a different answer too.
So let's see. So NPV. So if let's do the following. What I'm gonna do is I'm gonna insert lines here. Insert some rows. So this is 0, right? 1, 2, 3, 4, 3, 5. We'll do the same discount rate. Let's do right. So we do net present value, discount rate, and then in this case you need to add the 0 at the beginning, because you need to allow Excel to know that the first cash flow will be 1 year from now, not today. So you do it like this. That's the NPV, and then so it's different. It's a different value. So the right way of doing it is the way on the top. You need to allow Excel to know that time zero is the initial cash flow. Tell me what is the example that you saw with Professor Ross? Was that different?
Exactly same example, but he's adding up.
So what he's doing is adding up from, let's say, time zero, and then subtracting the initial investment.
Yeah.
Well, you do need to include that in the cash flows and count it as the initial period, as I have it here with 0 as a starting point. So, in other words, what the formula is saying, or what we're seeing here conceptually, is you have your initial investment at the final point of the initial period, and then after that you have the subsequent periods, and then you're discounting them. So I think it's a matter of just determining exactly when you're starting your investment in your project, and just aligning that accordingly. So in this case, we're assuming that the starting point is when you're making the investment. In this case, we're assuming you're making the investments at the end of the period, and that is why we're having the difference in the end result. But it's the same math. It's just conceptually when you're starting your project. Are you starting your project today, and today is your point zero, or you're starting your project a period from now?
So how do we do that in Excel to make sure we're all matching up the periods when the payment starts? Because I'm still getting different answers when I do type out the way we were talking about. I'm getting like 137 instead of 124.
Yeah, no, you get 137 if you're not discounting the first cash flow. So in this case, you're getting 124 because you're discounting 1,000 for the first year. Okay, so you have a negative number that is discounted for the first period, and that is contributing to the cash flows. In this case, you're not discounting the 1,000. That's where you're getting a slightly higher figure. So it's again, in Excel you do the exact same thing. It's just a matter of matching whatever you're saying in the problem. Are you starting your project today, or are you starting your project a period from now?
Okay.
If you're starting your project today, would be the way Professor Ross is explaining you, or the one that is yielding here the 137. Right?
Okay.
Okay. I think you had a question? Same question? Okay. Is that clear? That's a very good point and an important point. It's just a matter of when you're starting your investment and where your problem is setting your investment to begin in. Okay.
It's basically because the $1,000 is, or whatever the 1,000 is worth, the value of that 1,000.
The value of that 1,000 is discounted.
Period, but
Yeah.
it's the present and the future. Yeah.
Exactly. That is why you're having a difference. And obviously, if you're considering your project starts now, there's no discounting for that 1,000 figure. So. Okay, so what I have here in lines 17, 18, 19, 20 is just playing around with the different variables. If you have a rate and a payment, you can calculate the number of payments, so in this case 5 years. Or if you have the 5 years, the discount rate, and the present value, you can also calculate the payments. So you can play around with the different parts of a cash flow and calculate different points. So that's net present value, net number of payments, or the amount of the payments. Okay, and those functions. For those functions, it applies exactly the same. If you're starting your project today, you're not discounting your first cash flow. You take it out of the equation. If you're starting a year from now, then you include it in the discounting range in Excel. Okay. So Okay, that's for the time value of money. Then very quickly some statistical functions: min, max, average, is, error, if, and or. So here we have just a random set of numbers. Later on I will show you how we can apply these functions. Right now I just wanted to see how they are used in Excel. So the max within a range in Excel will just give you the maximum within that range. Min, the same, will give you the minimum within the range. The average calculates an average for that same group. If is simply conditional. If one figure, then you have a condition, and you compare it with another figure, and then you have if it's true, the first answer. If it's not true, the second answer. So in this case, if B2 is greater than B4, then return 1. If not, return 2. So in this case, it's 1. That's very simple.
Can you use that for anything other than greater than or equal to, or when would you use the if, or is that the only instance you would use the if function?
No, you can use it in many other instances. For instance, you can also say if they're equal. You can use all the different equal, greater than. You can also do nesting. You can nest another if or and or within an if function.
Okay.
So we can increase the complexity of a formula if you want to. In my opinion, and we'll go over that when we go over the modeling principles, it's better to keep very simple formulas and one step at a time so that you don't get lost, because otherwise Excel spreadsheets can grow and get really complicated and messy. Another function that is useful to clean data is error. So for instance, Excel is not very well suited for imaginary numbers, so the square root of -1 it returns hash num. So there's a function here, if, and this is another example using if with something else than greater or less or equal than. If that number, so in this case is error is a function, if that number returns an error message, then choose the maximum of the first range, and if not, return the minimum of the other range. So you can play around with that function and do many things that are very useful when building more complex financial models. Okay. So that's the first point that I wanted to show, just the basic financial math and the basic Excel functions that we're going to be using building Excel models. The next section is financial accounting elements and how to use them in Excel. So you've already gone through this in the previous sessions with Professor Ross. Have the income statement, the balance sheet, and the cash flow statement. These are the three basic financial statements that we are going to be working with. The income statement, or the profit and loss, well, as you already know, tells you the operations within a period for a company or for a project, from revenues, costs, and expenses to the net income. So the net value that the project or the company is creating for that period. The balance sheet shows you assets, liabilities, and equity, so it gives you an explanation of how the operations that are generating those cash flow streams or those incomes are funded and how the equity is growing. And then the cash flow statement ties together the balance sheet and the income statement, so that you can also have a very precise sense of how much surplus cash is available for dividends or for reinvesting, or if you have a deficit, if you need financing, debt financing or equity financing. The income statement, the main items that we're going to look in an income statement from top to bottom: revenues, cost of goods sold. As you know,